As a South African.
You are.
Apparently.
Okay, good morning, everyone. I'm Michael Mullan from the OECD, and I'm joined by Nicola Ranger from the UK Centre on Greening Finance and Investment. So we're delighted that you're joining us this morning for this event that's hosted in the beautiful EIB pavilion as a joint session between EIB, OECD, and the Centre for Greening Finance and Investment. We're very excited both to share some of the work that we've been doing, but also then for the excellent set of panelists that we've assembled for the subsequent discussion on the fundamental question of, we know the physical risks of climate are happening now, we know they're getting more severe, and we know that the investment decisions we make will fundamentally affect how well able we are to address those risks. You know, are we locking in vulnerability, or are we building resilience? So with that, I would like to hand you over to Nicola.
Thank you. Could you bring the slides up, please?
Sorry, I'm asking to turn my mic off. So I don't make any noise, but we don't have to do it. Sorry.
My line as well.
Yes, we're all live.
Oh, great, okay.
I'll just keep quiet.
You can do a running commentary while.
No, it's off. Oh, no.
No, it's on. Mine's on.
Okay, so keep any kind of controversial whispers to yourself. Perfect.
Okay. Well, good morning, everyone. Thank you so much for coming today. So we're going to talk to you about a concept that we call adaptation aligned finance. So what this basically is looking at how we can ensure global financial flows are aligned with adaptation resilience goals. So this isn't quite the same as adaptation finance. It's not the same as risk management. This is a much bigger concept. And we're going to explain to you why this is important, but also start talking about how we can actually move towards making this work in practice. So the first thing to say, and it's obvious given that we're all here, the climate emergency is already here. This isn't something that's going to happen in the future. You know, the Swiss Re a couple of weeks ago announced that 200 billion losses in 2020. The WMO last week released a report saying 2 million people have died already around the world in climate-related emergencies. This is happening today. So adaptation is urgent today. The IIGCC in August showed us that the risks, painted a picture of risks that were unprecedented, and really showed why this is an absolutely critically important problem that we be dealing with now on the adaptation side as well as on the mitigation side. So what we really want to focus on now is how do we bring risk and physical climate risks into financial decision making, and why this is important? Because financial decisions are made on a daily basis that have a big impact on risk around the world, be it, for example, how we construct our infrastructure, how we lay out our cities, deforestation, biodiversity loss, all of these things that are related to financial decision making that aren't necessarily explicitly taking into account these physical risks, but are inadvertently impacting on our societal resilience. And these are big decisions that are significantly impacting on our resilience today and our ability to adapt in the future right now for decades to come. So a lot of my work as a practitioner has been around working with financial institutions, ministries of finance, the insurance industry, looking at how we can create this signal of risk in decision making. But what we're going to try and convince you of today is it actually needs to go broader than that as well. And why does it need to go broader? So if you can imagine here we have 60 blocks. So as an example, total infrastructure investment globally last year, so 2.7 trillion. And that is 60 times greater than all tracked adaptation finance. So you imagine when we're focusing on adaptation, at the moment, we're almost sort of running against a wave of finance that is flowing in the other direction and potentially making us less resilient as a society overall. So what we're arguing about is we need to not just focus on this 60th, we need to focus on the whole picture. And this is just infrastructure flows. In 2020, total assets under management globally were 110 trillion. And that's only assets under management. The financial sector is much, much bigger than that. So we have a whole system which is influencing our resilience globally and is not taking into account physical climate risks in the main. And we know that because a huge amount of research has shown that many decisions are not taking into account these risks. They're perceived as small compared to other risks. They're perceived as long-term. And we have very little transparency at the moment about to what extent financial flows are impacting on our resilience. We know that it's happening. We know that as a society, we need to build resilience. I think if we've seen anything in the last 18 months with COVID, it's that we need to take some desperate actions now to increase our resilience, both to climate and other shocks. But at the moment, we're not even able to track how our decisions that we're making now are impacting our resilience. So we suggest that we need to move towards much greater transparency about the impact of financial flows on resilience globally. And once you have that transparency, then you can start to make better decisions. So ultimately, there's a need not just to increase billions to the billions of financial flows into adaptation, but fundamentally to align the trillions of public and private financing flows with climate resilient development. Now, we're going to focus here today on the private, but actually this is an issue on the public side as well. If you look at, for example, financing for COVID recovery, only about 2% of that went into adaptation and resilience. So we're not actually even really mainstreaming adaptation into our public financial flows, but we're going to focus here more on the private financial flows. Another reason why this is absolutely critical comes back fundamentally to the Paris Agreement. So Article 2.1c of the Paris Agreement calls for financial flows to be aligned with both mitigation and adaptation flows. Now, there's a huge amount happening globally on the mitigation side at the moment. We've seen GFANZ, for example, announcing 100 trillion of assets now being aligned with net zero goals, but actually there's not a mention of adaptation in there. So what impact could this have, and what benefit could beginning to have a conversation about aligning those financial flows with adaptation as well? The other point I'd make is about investor expectations. There's huge demand from the investment community for good investments that are aligned with adaptation resilience goals. We've seen this, for example, in growing markets for resilience bonds. There is huge investor demand. And again, if we can create transparency about the impact of these financial flows, then we can help, hopefully, to redirect those through investment. So part of this is about pricing, how we price and account for physical risks within decision-making in financial institutions. Called this the Carney tragedy of the horizons. When climate change becomes a defining issue for financial stability, it may be already too late. So we need to be incorporating those risks now. But that's only part of the story, because when we bring in risk into financial flows, that's just the risk to an individual asset, an individual investment. It's not the risk that that asset or investment has to society around it. Part of this is obviously around adaptation finance in a traditional sense, in terms of the opportunities, insurance, providing finance for smallholder farmers, etc. But we also have the Caldecott alignment dilemma, and that risk management and alignment are not the same thing. And in many cases, when we're managing, if a financial institution is managing risk, actually that could have negative impacts for communities around them. For example, if a bank is bringing in risk into thinking about, should we finance investments in vulnerable countries, but is not thinking about adaptation, actually that could mean that they draw capital away from vulnerable countries. So adaptation alignment is absolutely critical to ensure that when we're managing risks, we're doing it in a way that supports adaptation. So this is about, it's about the billions to trillions. It's about directing the trillions of financial flows in ways that support resilience and adaptation, or at least don't damage resilience and adaptation, don't make things worse. And to do that, we need to make clear what financial flows or investments are Paris aligned, and this has to include adaptation. And discipline and transparency over what is aligned and what isn't is the starting point, because at the moment we just don't know. I'm going to hand over Michael to talk about how we actually do this. But what it means, so it means ensuring that adaptation is consistent with the needs of climate resilient development. It means, for example, not investing in activities that could actually make things worse for communities, and proactively looking for opportunities to make things better for communities through finance. It has a lot of parallels with nature-aligned finance. The two things, resilience and nature, as we know, are very interlinked. So this discussion is very linked with the TNFD, for example, discussion.
Excellent. So hopefully Nicola has convinced you of why this is important, why it's something we need to work on. But I think we shouldn't underestimate the difficulties. We know this is important, but we know it's not easy to do. And particularly there's significant technical and conceptual difficulties that need to be overcome. And that's why we're framing this very much as a discussion, a consultation, and a longer term process. They're listed here. I think they'll be familiar to probably everyone here. But the critical bit, I would say, is this, adaptation is a process rather than an outcome, but at the same time, it's a process that leads to certain outcomes. And until we have a better defined sense of what those outcomes are, it becomes very hard to say, is this aligned or is this not aligned? The good news is we're not starting from a blank sheet of paper. There's a number of existing alignment frameworks that have been developed for specific purposes. So we've highlighted here the work of the World Bank, the EBRD, maybe if I move here, that's better, and also within the EU taxonomy. They all have some common themes. Firstly, a positive framing. So it's all about identifying what is aligned. It's not about what, except implicitly, isn't aligned. Secondly, it's process-based. For each of these measures, the key part of it is, has there been some process to understand what are the risks and then manage those risks appropriately? And then a few others which I'll skip over. So here's our starting point. And again, I very much say, this is not the answer, this is really the start of the discussion. What would it mean to say that an investment is aligned or finance flow is aligned? For me, it would involve, well, for me and for Nicola, it would involve the following elements. The first is fiscal risk management. That's essential, but it's not any type of fiscal risk management. There has to be a second point about do no significant harm. Managing your own risks shouldn't increase the risks faced by others. Also within that framing, obviously it should be aligned with mitigation goals. And then lastly, resilience is a systemic function. It's not just one project, another project, it's how the elements fit together. And so at a minimum, whatever the intervention is, should be consistent, or I think in the EBRD terms, not inconsistent with the broader national adaptation plans, local strategies, and so forth. Moreover, if the project is not just saying this is aligned, but this is making a positive contribution, it needs to also be able to demonstrate positive contribution. It needs to make it cheaper, easier for others to adapt. So next steps. We're not just doing this out of interest, like partly it is out of interest, but mainly it's to ultimately help shape how these finance flows go. And for us, there's three parts to that. The first part is defining, having the discussion about what is aligned, what isn't aligned, bringing together different perspectives to feed into that. And we're delighted to have a range of those perspectives actually reflected today. Secondly, measuring. It's fine to have a goal, but if you don't know if you're making any progress towards it, is it a real goal? So in parallel, we'll be starting work next year to try and operationalize the concept and start to measure what's happening with the degree of alignment. And then thirdly, mobilizing. How do we increase that over time? In the same way that on the mitigation side, there has been increasing momentum and we're seeing increasing action. What's needed to enable that on adaptation? The background paper is here. We'd be delighted for you to take a look. But before then, I would like to invite our panelists to join us on stage, please.
Ben said he'll be back.
Our first panelist, I'm delighted to introduce on stage Stephen O'Driscoll, who's the head of climate, environment and social policy at the European Investment Bank. In a way, it's not a coincidence that we're here because EIB have just launched an ambitious new adaptation plan. Please, can you tell us a few words about how EIB are helping to drive adaptation and life finance?
Can you hear me now? Yeah, okay. Thanks very much, Michael. Thanks. Good afternoon now, everyone. Thanks for making that point. Yes, we've just launched our adaptation plan. It's actually up on our website if people would like to look at it. So, and we've got a launch event with VP Timmermans later this week. So looking forward to that. I'd say we're very pleased with it. I mean, adaptation from finance has been part of our climate strategy for a long time. And we've really mainstreamed it at the project level. But this is really the first time we kind of stood back and thought, you know, how do we want to move forward with this? You know, it's clear that we've got a major issue here, and how can we as a public bank help? I think we have a unique role to play in this. You know, and to your question, how are we going to drive investment in the right direction? I mean, it helps for us to be policy driven to an extent. And of course, we kind of stand behind the EU adaptation strategy. You know, the barriers are well known. You had them up on the screen there. So clearly, we're trying to address those. And I think the question for the EIB is then how we can best use our capital to try and overcome some of these. And for us, that means not only our financial resources, but our human resources as well, because the unique part of the bank is that we have a very large technical advisory service as well within the bank, rather than having to go outside for that advice. So I think as an MDB, we have, there's 4 ways we can do that. Mm-hmm. I think we have the power to convene in some ways. And by that, I mean, we enter into a very early and robust dialogue with the promoters, not just about, you know, minimizing the risk to the EIB loan, but, you know, making sure that, you know, from a project point of view, they have all the right assumptions in place. We can check that, you know, their project sits properly within the overall policy context and so on. We can provide, as I say, technical assistance and advisory capacity. That can be at a project level again, so a climate risk vulnerability assessment, but it also might be, you know, further upstream when we're talking to a bank who doesn't really understand how to embed physical risk in its lending portfolio. And we are actually beefing up our internal expertise in this respect. So I'm very happy that that's an outcome there. I think probably most importantly, of course, as the EIB, we can provide very long-term finance. And so that's important, you know, for you know, the kind of long transition pathways that we're looking at. And we can help to drive down the cost of capital in that respect, provide a little bit of certainty and confidence. So that's very important. And then also we can help share the risk a little bit, especially through access to EU budget facilities and we can come up with various risk sharing mechanisms, maybe for a PPP or with particular innovative products or services. So I think from that respect, that's what kind of sets ourselves apart. And then the plan itself, I mean, it's structured around the EU strategy again. So that's about smarter, it's about faster. And, what we put in place there is very much responding to those. And it also addresses the international dimension as well in terms of, the most vulnerable regions. So we're concentrating on LDCs and SIDS and so on. So that's the kind of adaptation in a nutshell, and we're going to roll it out over the next few years, and we're very excited about it. Yeah.
Fantastic. So look, over to you, Amal-Lee. So Amal-Lee Amin, Director of Climate Policy at the CDC. So last year you made an ambitious commitment on adaptation and resilience. Could you say a few words about what's been the experience since then? What have been the opportunities? What have been the challenges?
Yeah. So CDC, for those that may not know, is not the Centre for Disease Control. We're the UK's Development Finance Institute and an impact investor. So we only do private investment, and in Africa, particularly mostly sub-Saharan Africa and Asia, South Asia in particular. And so the markets that we invest in and the businesses that we invest alongside are particularly vulnerable to climate impacts. We know some of the most extreme climate impacts are already being felt: heat stress, flooding, prolonged droughts. And I think, as I just want to say before I go, I will say a little bit about what we're doing at CDC, but I do want to say I think this report and opening up this discussion around these issues is absolutely essential, because at the moment the focus is, when we, particularly in this discussions here around the 100 billion, the focus is almost entirely on adaptation finance as an input, does not consider whether or not that is actually going to deliver resilience over time, as Nicola emphasized. And often the focus is at the project level and not thinking about whether it's building resilience at a community level, let alone at a more systemic, wider level. So really important that we start to collectively look at how we are fully addressing physical climate risk. And I think, in the way we at CDC are looking at it, we have set adaptation resilience as one of our core building blocks of our approach towards Paris alignment. The other one to be net zero by 2050, and the other second one being how we can invest more and how we can engage with our investees around the just transition as well. And the way in which we're looking at it is, to a large extent, a little bit as was flagged on the presentation, how the World Bank resilience rating system, we look at the resiliency of all our investments, and then how we can invest more to deliver resiliency through our investments. And I think here, probably and both are really essential, but they're really quite different agendas as well. So in terms of the resiliency of, I think, as Nicola emphasized, there are a number of, there's increasing number of tools starting to emerge, particularly by sector. I really like actually the one that Climatize developed quite recently with cotton, what do they forget that it's basically looking specifically at the cotton sector, and looks at all the main cotton growing areas in Asia, I think. And I think it's, as a tool, it demonstrates this whole issue around context specific. There is no cookie cutter approach to this. It is a much more challenging agenda, and it is an essential one as well. If we get it wrong, then as we know, we will become increasingly peril to different impacts. So ensuring, as CDC, we've started to do this both internally, but we realised that actually, given as DFIs and given we're kind of at the interface between public-private finance or the public sector, if you like, and investors, particularly those investors who as Nicola said, could start to move away from the most vulnerable countries and certainly the most vulnerable sectors in countries, particularly in light of now the Task Force on Climate-related Disclosure, where they will want to know, are assets resilient? And if they don't have transparency, they don't have certainty, then just why would they want to take that risk? So that could mean whole continents. I mean, the whole of sub-Saharan Africa could be seen as even more risky for investors. So, we've actually over the last year really now, we launched a new collaborative to work with other development finance institutions to see how we can actually collectively start to identify what is really good practice in terms of physical climate risk. I'm delighted that EIB joined as well. We call it DFIs Plus, so the DFIs that are focused just on the private sector, but we really welcome those who do both public and private, because we know that a lot of what needs to happen is exactly as you were just saying, in terms of particularly being able to provide the technical assistance so that governments start to put in place the right kind of measures to incentivize resilient measures, which could be building codes, building standards, for example, as well as starting to overcome market barriers to potential private companies that will be needed to help deliver resiliency services. And so, through this collaborative, we're hoping to really address many of the issues I think that this report highlights. So I'd just like to congratulate and thank you for it.
Excellent, thank you. I might also warn you that your phone is imminently about to plunge to the floor. It's on a string. That's
I will lose it if it's
that's resilience in practice. Anyway, I'm now delighted to turn the virtual floor over to Alan Smith, who's joining us remotely. Alan's the senior ESG advisor at HSBC.
Thanks, Mike. And again, a real pleasure to be here. I'm actually traveling up to COP on the weekend, but really a privilege to be here because this whole aspect of aligning finance with climate resilient development is essential. And I'm speaking to you today with almost two hats on, with my senior advisor ESG risk here at HSBC, and also with being chair of the Systemic Resilience Forum of the CCRI, which has had as its real kind of laser-like focus and actually partnering with a number of the organizations on the panel about how we really are ensuring that finance is being aligned to climate resilience development. And that is important from our perspective, from what I would almost say from 4 Ps, from a purpose perspective, from a product perspective, from a process perspective, and from a people perspective. In terms of looking at the purpose, I can't emphasize enough how critical physical climate risk is in managing and understanding as institutions, whether it's public or private sector like ourselves. Sometimes it can almost feel as if physical risk are the poor relation, but no, they're equally needed to be looked alongside transition risks. We cannot get to net zero effectively and in a just manner unless we are actually looking at physical risks and the resilience at the outset. We need to be resilient first if we're going to be able to get to net zero, and that's a really important thing, and that's why the paper brings out why that is essential. Also, even when we look at the numbers and even of what we're talking about, coming into the COP, people are talking about the 100 trillion that needs to be released. But we, in order to spend the 100 trillion effectively, we actually have to show that we are spending the 100 billion that we committed to emerging markets and developing countries 10 years ago. To spend the 100 trillion, we now really have to show that we're spending the 100 billion around resilience, around aligning capital towards being resilient for those physical risks. So whether it's in terms of the product dimension, in terms of how we're beginning to look at our infrastructure lending, how we begin to look at wholesale commercial real estate in emerging or developed markets, beginning to realize that we need to be thinking about the impact of physical risk and how we look at those products is important even from now. In terms of our processes, in terms of risk identification, in terms of modeling, in terms of data, in terms of scenario analysis in particular, even from now, that aspect of making sure that physical risk are properly modeled and brought into that is key. And then the last one is actually people, not just building the capability internally, but actually making sure that externally our people are engaging on the things which will make a difference. And there are two in particular which I'd like to call out. The Fast Infra Coalition, which is really looking about how we ensure that we build the frameworks and the market frameworks, and in particular labeling frameworks, so that people have the understanding and the transparency to be making sure that they're aligning finance to address resilience in emerging markets. We're actively involved in the Fast Infra one because that enabling of the private sector is important. And secondly, with CCRI, which I talked about, looking at it from 3 dimensions: the systemic dimension, building tools to make sure that at a national level, we can assess the relative and absolute decisions around where capital and finance needs to go to address those areas that need to be prioritized first. At an asset level dimension, building out the methodologies to ensure that we're properly pricing those risks. So again, private sector money can go, or whether it's blended finance, that we know how to do it, and actually using that together to guide finance to the area. But really, again, really welcome this opportunity. It's important. Physical risk is not the poor relation. They're essential to us achieving the world that we need to. And again, the areas of focus today are spot on in bringing it to the fore. So thank you very much, Michael. And those are my perspectives.
Thank you. And possibly I should mention, actually, OECD just joined CCRI. So we're also supporters of this initiative. Okay,
Excellent.
now to give the word over to Emelia. So Emelia Holdaway is Policy Director at the Institutional Investors Group on Climate Change. So hopefully you've been convinced by what we've been saying this morning. Is the microphone working?
I'm not. Oh, yes, it is. Yep, coming in.
Okay, we're in action.
Yeah,
Fantastic.
Emelia Holdaway, Policy Director at the Institutional Investors Group on Climate Change, or IIGCC. In case you don't know us, we're a Europe for investor collaboration on climate change. And we've been, I'm really appreciating this discussion. You don't need to convince me. I think it's something that we're all learning as we go, and we're learning together. We have, in terms of our membership, we have 350 members, mostly asset managers, pension funds, collectively managing around 52 trillion euros in assets. And for the last, I've been working specifically, I'm really coming in and out, aren't I? Fortunately, I'm Australian, which means I'm loud. We've been working on the Paris-aligned investment initiative for several years, which is really looking at what does it mean for investors to align with the Paris Agreement. We've got a huge ball of momentum rolling around decarbonisation. So we have 50 asset owners and over 200 asset managers who've now made net zero commitments. So that's 57 trillion US dollars of assets under management. That's more than half of all global assets under management. So I think that's a real tipping point for the sector. But we've always been clear within the Paris-aligned investment initiative that this is about the mitigation goals of the Paris Agreement, but it's also about the adaptation goals. And that's where we're all working alongside you and learning and working out how to do this and what this means. In September this year, we published a guide to support investor engagement with companies on resilience. I'm looking down at my page so I get the title right. Investor Expectations of Companies on Physical Risks and Opportunities. The lead authors for the guide are IIGCC, alongside the UK Environment Agency Pension Fund and Australian Super, but more than 50 investors inputted into the guide globally. And I think some of the things that, where we've got to on it is really similar to, I think, Nicola and Michael, what you were setting out. So given the challenges of setting quantitative targets for climate resilience, we're recommending a process-based approach for aligning investment portfolios rather than a specific quantitative target to be achieved. That does mean that there isn't a simple endpoint when an investor can say an asset or a portfolio is fully resilient or adapted or otherwise aligned. And that's partly about uncertainty about the climate impacts that are to come the next 10, 50 years and so on, but also because we've only got a partial picture of what adaptation-aligned pathways would be. And that's partly what Amal-Lee was saying about the impacts being very context-specific, sector-specific, but geography-specific at the subnational level. And for those of you who are familiar with vulnerability assessment, it's also about understanding not just physical impacts of climate change, but the capacity to adapt to those impacts of climate change. So sort of the approach we're taking is very much about investors needing to identify and support assets to increase their resilience by developing resilient strategies. So really akin to investor engagement with corporates on their net zero transition plans. Investors are very likely going to be taking the approach of prioritizing sectors for intervention that present material risks, so sectors that represent the bulk of their portfolios, as well as identifying sectors that can provide adaptation solutions to forecast, mitigate, respond to extreme weather events and changing climate patterns. Within the guidance that we developed, with that prioritization in mind, IIGCC members chose to focus the guidance on energy, mining, transportation, utilities, and several manufacturing subsectors, because those were considered sectors relatively more exposed to physical climate risks, but also having a critical role in building societal risk. And I think something that's quite important within the guidance and the expectations of companies is we're not just looking for companies to improve their own resilience, but also to look at making a societal contribution to resilience. So if you operate in an area where water is scarce, yes, we want the corporate to be engaging with, say, the water utility around security of water supply, but maybe also looking at their own water management practices so that water is available to all of the stakeholders in that area in scarce times. Maybe I'll leave my opening remarks there, but yeah.
Our fifth panelist, will make a little bit of room for him too.
I can perch here, that's okay. Oh, my phone. So thank you for the very kind invitation, and congratulations, Nicola and Michael, for a really thought-provoking and powerful and I'm sure influential paper. Now, I'm based at the University of Oxford. I also direct this UK Centre for Greening Finance and Investment, but I've been invited today to speak with another hat, which is as the chair of something called the Finance Sector Expert Group that's been set up for Race to Zero and Race to Resilience. And I wanted to tell you a bit about that. So the Finance Sector Expert Group was set up this year. We have a number of distinguished experts, including Amal-Lee, who sit on the group, and we've been established to do a number of things. The first is to advise the high-level champions on the interpretation of Race to Zero and Race to Resilience criteria for the finance sector. We've also been asked to begin producing guidance and related materials to help with that interpretation. We're also supporting the body that's responsible for assessing Race to Resilience applications, the name of which I'm not actually sure. I'm not sure whether it's got a name yet, but the equivalent for Race to Zero is the expert peer review group. There's an equivalent of that for Race to Resilience. And a few and other bits and bobs, but we inevitably, with all of this, and this has been reflected in the comments from the other speakers, the focus has been on net zero, it has been on Race to Zero, and we haven't done enough yet on Race to Resilience. And so we've set up now, very early stages, a new working group within that expert group that will be working on Race to Resilience and really will be accelerating its work early in 2022. So I'd urge you to get involved. And that's a really big priority. I think lots of things have been said already. What should we be learning from the net zero experience? And there are lots of things we can learn because it hasn't been particularly smooth. Actually, it's been quite difficult, and some of that will come to the fore, I suspect, tomorrow on Finance Day. You know, how it's all very well making these commitments. How do we make sure that they are credible? What's the accountability mechanism or mechanisms that exist? What's the governance surrounding these commitments? How are we tracking these commitments over time? I really liked the point that IIGCC was making around, essentially, you know, we're talking now a lot about net zero transition plans. Obviously, the national adaptation plan. Shouldn't we be talking about adaptation plans for companies and for financial institutions too? I think in the UK 2 weeks ago, we announced that through our new sustainability disclosure requirements, all companies, all financial institutions, all investment products would have to disclose on a comply or explain basis net zero transition plans. I think there is scope within that framework to extend that potentially down the line to adaptation plans. And that's where the rubber hits the road, because you know, that's where you can see what corporates are doing, and you can assess what they're doing. You can engage with them actively, hopefully, and you can determine which ones in your portfolio are doing more, doing less, ones that need to improve. And I think we can accelerate this process. So it doesn't need to take us 3 or 4 years to get to the same point. We can move really very quickly in 2022, and this paper is going to be a really important part of that. So thank you for allowing me to join you.
Excellent, thank you. So look, I'm conscious we've only got a few minutes left. For me, this has actually been a real pleasure, not just in the like polite sense of this is really nice, but genuinely to get the depth of expertise and the range of perspectives here today. I hope this will be the start of a much longer discussion. I think Nicola hopes the same. And I think we see the importance. I think we start to see the way forward. But I'd like to just leave with a kind of a parting question for all of the panelists, which is, in the next year, what would you like to see happen to really move forward on making this a reality? Please.
Well, the sooner we see resilience getting an equal, coming on an equal footing to mitigation, that's for sure. That would be helpful. I mean, from our own perspective, we need to operationalize our plan now. We need to further mainstream resilience into everything that we do. We're just actually launching a Paris alignment for counterparts framework as well, where we're looking beyond the project at the counterpart behind it and the wider corporate activities that they have. And we're making sure that that has both mitigation and an adaptation perspective. Our climate risk screening tool as well, that looks at both mitigation and resilience and taxonomy as well. There's a bit of work to do in looking at how to do no significant harm criteria, you know, how we can demonstrate compliance with those with respect to adaptations. So hopefully if we can make some progress in all of those things, and you know, we'll be very happy with that.
Fantastic. Alan, please.
I think the two quick things. First, I think with the systemic national prioritization tool that we're kind of piloting in Jamaica with the CCRI, which but also can be leveraged to both developed and developing markets, which helps us to really understand the areas that need to be prioritized for investment for resilience. That's the one thing. But actually, the more fundamental thing is that I want us to be thinking about another net zero. That there's net zero to the amount of money that has been spent compared to that 100 billion commitment. I want there to be a zero gap to that. So there's another net zero. And if we make that net zero happen, I think we're on the track that we need to be.
Excellent. Amal-Lee.
So I think a lot of things actually, but I think maybe I'll just give two. One in terms of where with the collaborative now, some of the work we're doing, you know, I think we have a great opportunity over the next 12 months to really move us collectively forward as a group of DFIs with MDBs, and then engaging with the private sector on physical climate risk. I think we also need to ensure that as we think about metrics that go beyond input metrics, finance as an input metric, then that in that way we will be better able to identify those businesses and the business opportunities that are going to be better able to contribute to adaptation and resiliency services. And in doing both of those, I just want us to all come together and actually really start doing this, investing more. We will need some grant funding or early stage funding because many of these companies are very, very small. They're very nascent, often very innovative. We've just last week approved an investment in one of our companies already in our portfolio to enable them to provide insurance for the agriculture sector, taking on board climate risk and harnessing artificial intelligence to how the data is managed. So part of that is going to produce a lot of really relevant data that will be valuable to actually move forward this agenda with other companies and in other contexts as well. So a lot of really, I think, interesting stuff, but we need to really step up and come together to actually deliver. And I hope certainly by Sharm el-Sheikh COP, we'll have a lot more to show in terms of real businesses that are coming forward delivering these adaptation resiliency services.
Which has been said, please.
So the coming year, so what Christmas present 2022 would investors like? Well, as I've already mentioned, resilience integrated into companies' business strategies, publicly disclosed, ideally backed by capital expenditure. At the same time, investors will need to be increasingly proactive in identifying adaptation investment opportunities. And there's a whole range of sectors that can be providing adaptation solutions: water management, weather services, environmental consultancy, healthcare, and so on. Something I might also mention in case you missed it. So yesterday, the Climate Investment Coalition, which IIGCC co-leads, announced a new commitment from UK and Nordic pension funds, 130 billion of finance towards climate solutions by 2030. And some of the investors that made commitments within that environment agency stands out, have said that they will be tagging that particularly for adaptation and nature. So we'd like to see investors doing more of that.
Fantastic. Ben.
From me, so the first is building off this huge resilience challenge we've had with COVID, of course, is exploring legal duties to contribute to resilience. And how do we, what are those existing duties and how might we create new ones? I think it's very interesting. I think by the end of the year, we should be, at least in one jurisdiction, introducing a requirement to do adaptation plans for corporates and financial institutions, even if that's at a very voluntary level. And maybe the UK is a place where you can make some progress. I think by the end of the year, it would also be good to have some tracking systems in place, focused on portfolio level assessment. And lastly, this is a really big opportunity for sustainability linked finance. So shouldn't we be having a flourishing of different sustainability linked bonds and loans that are tied to resilience and adaptation? I think it's a very exciting and important area.
Excellent. Well, look, before we wrap up, I'd like to give the final word to my co-author, Nicola, please.
Well, I think it just falls to me to sincerely thank our speakers. Thank you to EIB as well for hosting this discussion. It's been a very fascinating discussion. It's great to have this feedback, and I invite those wider audience and online and in the room, please do have a look at the paper and please do send us your feedback, because this is really the start of a discussion. It's a start of looking at how can we actually operationalize this, and please do get involved and give us your feedback. And if I can add one more thing that we should do over the next year is around data, because all of this as well is based on having a shared understanding of risk. And actually, we're launching this week, actually later in the week, something on that with the insurance industry and the UN. So please do come to our other event later this week. But yeah. So tomorrow evening with the Insurance Development Forum, and as well as on the 8th, on Adaptation Day, we'll be launching an initiative called the Global Resilience Index Initiative, which is a global open risk metrics to provide this common understanding of risks that we need to move forwards on this agenda as well. So I'll finish there and just say thank you very much to all of our panelists and our speakers. Thank you, Alan, for joining us online as well.
Thanks.
Really appreciated it. And yeah, thank you for listening.
Yes, thank you. It's been a real pleasure. Thanks.